Thank you for joining in on a Saturday morning. Today, I'm Yash Tanna, research analyst. I cover the healthcare sector at iThought. Today we'll be talking about the overview of the Indian pharma market, where we are, what are the key characteristics, what it takes, to build a successful Indian business. All those things. Yeah, let's start off. So, firstly, starting with the pharma value chain, right? Firstly, there's a key starting material, which is the basic raw material for any drug. That key starting material is processed into an advanced intermediate. There are companies that solely do advanced intermediate or do it with APIs. So then it's converted into advanced intermediate. That advanced intermediate is then converted into an API, which is more of a powder form. The API usually gives you the therapeutic effect of the drug, that we consume. So that's then converted into the API, and then finally it's converted into the formulation. Formulation is basically the tablet or the capsules or the injections or the ointments that we finally apply or take into our body. So that's how the pharma value chain works. So let's understand how big is the global pharma market, right? As of 22, FY22, the global pharma market was about $1.3 trillion, close to $1.3 trillion, and it's supposed to grow at a CAGR of 5% over the next 5 years to reach about $1.6 trillion. So globally, the growth is expected to be about 5% for the pharma market. Now, with respect to the global pharma market, right? How big is the Indian pharma market? Because globally, there are many geographies. So Indian pharma market. This is solely the number for the domestic market, not the number for exports. Okay, so only there are drugs being consumed in India. So that is about 1855 billion rupees, right? And that's poised to grow at a CAGR of 10% to reach 3100 billion rupees, right? So if we see in value terms, the Indian market is close to only 1.7% of the global market. So it's very small, but the growth is actually 2x. So the global market is poised to grow at 5%, whereas the Indian market is poised to grow at about 10%. So a much faster growth. Let's talk about the healthcare index, right? This is the index that has all the subsectors of healthcare, pharma, hospitals, API companies, diagnostic companies. So if we break down the healthcare index, right? The total healthcare index, BSc healthcare index is about 19 lakh crores, right? And if we break that down, pharma comprises the majority of the portion, right? Pharma is about 71% of the total healthcare index, followed by hospitals, which is about 15%, API and CDMO, which is about 6, and then diagnostics, which is merely a 2%. So in the index, pharma comprises a major weight. Yeah. And now let's divide that 70%, 71% of pharma into different types of businesses of pharma, right? So there are companies that are into branded generics, which is mainly the Indian business. Then there are companies which are into commodity generics, which is mainly the US formulations. Then there are companies doing APIs, and there are companies doing CDMO or CRO work. So below for each type of business, I have mentioned the companies that are doing that type of business. So let's say for the branded generics, right? Eris is doing close to 100% of business from India, right? Alchem is doing about close to 67-70% of business from India. Similarly, JB Chem, Ajanta Pharma is doing 68% with from India and emerging markets. So emerging markets and India, but both of these businesses are branded businesses. So I've listed down the names of the companies that are at least doing more than 40% of the business in the branded space. Then comes the commodity generics, which are only the generics. There is no brand name attached to it. There are the all the big companies like Dr. Reddy's, Sun Pharma, Lupin, Zydus, Aurobindo. All these companies have a major portion, a major chunk of their revenues coming from the US formulation side, right? Then comes the API companies. When you saw in the value chain, API companies are one step before the formulation companies. So these are the API companies: Loris, Newland, RP Drugs, Divi's Labs, and their respective, the percentage of revenues that comes from that business. And then there are CRO or CDMO companies, right? The CRO CDMO companies are basically partners for global pharma companies. They make drugs on behalf of these pharma companies, and that's basically the model for CRO CDMO companies. They either do research, they do drug development, they do drug manufacturing. So they are partners to other pharma companies. So that's the breakup of pharma. Now, let's dive into Indian pharma market, right? So how has IPM growth been over the years? This is data of slightly more than a decade, right? Uh, if we see, there are three main drivers to growth in the Indian market. One is volumes. Volume is obviously the number of units or the number of drugs that you sell, these pharma companies sell. The second is price. Price is the price increases that these pharma companies take on their branded drugs, right? Year on year, they'll take, let's say, a 2%, 3% price increase on that same drug that will be 2 to 3% more expensive the next year. And NI is basically the new introduction. So these pharma companies keep on introducing newer versions of these drugs, wherein we get a more advanced form of these drugs. It can be either on the drug delivery system, or it can be a better efficacy of the drug. So these new introductions are basically newer drugs that these pharma companies keep on launching, and that is captured into the growth from new introductions. So if we see over the last 10, 11 years, on an average, the volume growth has been close to 4.6%, right? The price growth has been close to 3%, 3.5%. And the new introduction growth has been about close to 4.5%, which gets us to a total of 12.5%, right? So this is broadly when we say the Indian market grows 10 to 12%, this is the breakup of the growth for 10 to 12%. Now, the overall market share so is very concentrated at the top. So majority of the sales in the Indian market are done by the top few companies, and it is very concentrated on the top, right? So here's a graph that we can see. The top 10 companies in the market almost contribute to 43% of the total sales in the market, right? That's a huge number. When we similarly we take top 20 that contribute to 65% of the total sales, and the top 30 they contribute to about 74% of the total sales. So it's very concentrated at the top. It's very important that you make bigger and bigger brands, and those brands provide for a majority of the sales rather than having thousands of brands in your portfolio. So I've just mentioned one interesting data point on the top left uh, on the slide, that the Indian market has close to 85,000, more than 85,000 brands, but one third of the sales come from the top 170 brands. So we can just, from this data point, we can just think about it, that majority of the revenues come from a few brands, and success of the brands is the major success factor here. Uh, yeah, and this graph shows us that the market has been dominated by Indian players, right? This is data for the last decade, slightly more. So we see that in 2011, the domestic companies, the Indian companies, had a market share about 43%, right? And that market share has increased to about 57, 58%. So they have gained market share from these MNC companies. And similarly, if we see for these MNC companies, the multinational pharma companies that are in India, the market share was about 17%, which has gone down to about 12%. So this has been a trend where the Indian companies have been, grabbing market share from these multinational players over the years. Yeah. Now, IPM is broadly, this is the broad diversification of the IPM. They will be divided on the therapy areas. So they will either be divided into chronic or acute, right? Acute are your illnesses, like you have a cough and cold, or you have a fever, you take antibiotics. So acute will be medicines that you consume for a specific period of time. The course that the doctor gives you, let's say you get a fever, you take these antibiotics for a period of 5 7 days, you get a cough and cold, you finish the course, and then you probably don't take those medicines, right? Whereas chronic are more serious ailments, like you there's a heart condition, there's a diabetes. So you have to take blood thinners. So those blood thinners are not for a specific period of time, right? You have to consume them for the life for lifetime, right? And They are consumed much more than the acute medicines are consumed because the tenuity of it is much higher. And this has been a trend of acute versus chronic. This is the last 5 year data, but even if you go back, the trend has been very constant that chronic share has been increasing in the Indian market, right? Because the chronic ailments like cardio ailments or diabetes, they have been increasing because of lifestyle changes, eating habits, and all. So the chronic mix has been increasing steadily. Now we spoke about acute and chronic. Let's break that down into therapy by therapy, right? So if we see which are the biggest therapy areas in the Indian market. So cardiovascular, which is the heart condition, which is basically taken for the heart condition. That comprises about 12% of the market share. Anti-infectives, which are your antibiotics and stuff, they contribute to about again 11.8 to 12%. Gastro is again about 10%. Anti-diabetics is again about 9%, right? So when we spoke about acute chronic mix rising, I want you to let's focus slightly on only cardiovascular, right? Cardiovascular, if we see in 2018, was 11.8% market. That it had 11.8% market share, and that has gone, to more than 12%. If we see anti-infective similarly, which is an acute therapy, that was 12.4%, right? And that has gone to 11.8%. So even in this we can see a trend, therapy area wise, that chronic has been outpacing acute. And how have the growth of these therapy areas been over the years? So again, a data point to continue on that trend, right? Cardiovascular has grown at about 10 to 11 to 12%, right? Anti-diabetic has grown more than 10%. And anti-infective has grown about 9%. Whereas the expected growth rates for anti-infective is 8-9%, and for diabetics or cardiovascular, it's about more than 10%, right? A low single digit. So this has been the trend, and this will continue to be the trend that these chronic, the market share of chronic will keep on increasing in the overall Indian market. Yeah. So let's come to some of the characteristics of the Indian business, right? The branded business that the Indian companies do. What are the characteristics of these businesses, right? So it's a prescription-driven business. The companies, Indian companies, have pricing power with them, right? The payouts are the dividend payouts. The payouts or the dividend payouts are higher. Then there is steady growth and less surprises, right? So it's not a very volatile sort of an industry. There's very low capex requirements, and ROCEs are usually very high if you are doing only a branded business in India. So yeah, so when I said prescription driven, it mainly refers to when you have some gastric problem, right, or acid reflux problem, and you go to a doctor in India. On the prescription, he will write you Pan 40. Pan 40 is basically the name of the brand. It's not the name of the drug. It's name of the brand that you're going to buy. And you go to the pharmacist, he'll give you a Pan 40 only, which is the brand of a company called Alchem. Whereas in the US, if you similarly go to the doctor, he will not write the brand of the drug. He will write the name of the drug. He will write pantoprazole, which is the drug that you're going to consume, and the dosage, which is 40 mg. And when you go to the pharmacist, he'll give you the best available medicine, which is probably at the cheapest price. So that's the difference in India and probably US. You know that India is more prescription driven by the name of the brand. When we spoke about high ROCEs and low capex and higher payouts, this is just I've taken three companies, a subset of three companies, and I've taken all these companies as MNC companies because these all majority of the business for these companies comes from the Indian market, right? And I've taken these companies so that we better understand what characteristics does this business have. So I've taken Sanofi, Pfizer, and Glaxo as a subset. If we see the ROCEs last 5 years for Sanofi, they have averaged about 33%, right? The dividend payout ratios have been on an average have been about 150%. Now 150% is that's a very high number. That's because on any given year when they cross 100%, the company has given out special dividends. So If we see, Sanofi has given out many special dividends. So the dividend payout ratios are very high. This is investment as a percentage of cash flow from operation. So this is fixed investment, the capex that the companies do. That has been very less, right? It is only about 10% of the cash flow that they generate. They have to invest back in fixed assets into the business. And despite of this, despite of such a higher dividend payout ratio, they still have 430 crores of net cash on their books. We can see a very similar case with Pfizer. They've done ROCs of 24%. The ratios have been dividend ratios have been 82%, and investment has been a mere 7%. And they have a huge pile of cash on their books, about 1850 crores, right? And if we see Glaxo, similarly, they've done 35% ROCs. They have done, 225% is the dividend payout ratio. It's a very high number because they'd given a very high dividend in 2020. And if we see your investment as a percentage of cash flow, right, it's slightly higher. It's about 37%, which is again a lower number, but slightly higher because they had taken a call to invest in a facility, which subsequently they sold off as well. So the investment that was done was sold off, and that is not captured in the CFO, but. Yeah, they received 1,600 crores by the sale of that plant, and despite of that heavy dividend payout, they still have about 1,600 crores of cash on their books. So this is broadly the characteristic of the business, right? That they generate high ROCs, they have higher dividend payout ratios, and the investments in fixed assets have to be very less. When I said steady growth and less surprises, what I meant, you can see in this graph, right? This is a decadal data. Uh, in no year over the previous 10 years has the growth been negative. Yes, there have been 1 or 2 years where the growth has been close to mid single digits, but most of the years the growth has been high single digits or double digits. So on an average, the growth has been 11%, right? So compared to an exports business or a US business where there'll be a lot of volatility, in some years you will have when you'll have products being launched in other markets, you will have high growth, whereas in other years when you don't probably don't win tenders, or probably the price erosion is much higher, you can have negative growth as well. So that's not the case with the Indian market or the branded business. You will grow. Usually there is growth. It can be lower, but the growth will be positive. And pricing power, right? We refer to the three drivers of growth. One was price. Here we can see the average price growth for these companies has been close to 2% over the years. It's usually higher than slightly higher than 2%. This average has been distorted because of two negative years of 2015 and 2018. So 2015 there was a NLEM impact for the companies. I'll talk what NLEM is. It's basically a regulation, price regulation by the authority. That's why they had a negative pricing growth. And in 2018, there was a GST impact, right? There was a channel. The retailers took a price revision in the channel, and that's why there was a negative impact. But barring these 2 years, which was a sort of a one-off, usually the brands have been able to take price increases in the range of lower double digits, right? So just to sum it up, taking example of the domestic branded business and US generic market, how they function. The market size is obviously, as we spoke, domestic market is very small. I mean, smaller, much smaller when you compare it to the US. It's about $20 billion, whereas US is about $130 billion. Uh, uh, Domestic business is a B2C business, US is a B2B business. The revenue visibility, as we spoke, right, because of the three drivers of growth, which are very steady, the revenue visibility for domestic business or the branded business is pretty high. And for the US generic business is pretty blurred because in some years you might have a regulatory issue, or some years you might not have more product launches. There's more price erosion, a lot of competition. You don't know if you'll grow at a similar rate or even grow, in the next year. Uh, Compliance usually for Indian companies, it's based on price, as I spoke about the NLEM. And for US, the major is the FDA, right? The FDA is the regulatory authority of US, that does inspections on the manufacturing plants of the Indian companies. And these inspections can lead to, letters on the plants, that disrupt the supplies. So that's a major hurdle for the companies that are supplying to the US. Pricing, we spoke about pricing. There is growth in India, whereas in US there is a degrowth. There is 6 to 10% degrowth annually. Revenue growth is usually 10-11% for India. It's single digit in US. This single digit is actually driven by double digit volume growth because price erosion is 6 to 10%. So your price of the drug will go down by 6 to 10% every year, and you have to cover up the price erosion, and you have to sell more quantity to grow. The margins are usually much higher for the India business, 25 to 30%. This is EBITDA margins. Whereas for the US business, it's about 15%. This is usually for a portfolio of only generic products. The margins usually depend on product to product, but as a portfolio, it can be less than 15% in a scenario of higher pricing erosion. uh, R&D spends for domestic. Yeah, so usually domestic companies they introduce generic products. These are me too products or copy products of the drugs that have already been launched. So they do not need a lot of R&D. Whereas there is some R&D requirement for the US business. ROCEs are usually higher, 20% plus for the India business. It's single digit for a US business. It can vary over the years, but yeah. Free cash flow generation, we saw in that slide, right? That the high free cash flow generation, dividend payouts are very high for the India business. It's low for the US business because you need a lot of reinvestments. Capex is, as we saw, the investment as a percentage of CFO is very low for India only branded businesses, whereas Capex for US generic businesses is high. You have to invest in the plants, you have to invest in quality to see that you meet the FDA requirements. Working capital again is very low for India. It's pretty high for US generics. The expenditure when you come to the P&L, usually the cost is the MR cost. MR is the medical representative or the employee that employ the pharma company. That's the major cost. Whereas for US, it's the compliance and the filing costs. Brand recall. This is a very important characteristic, right? When I said the prescription-driven business, the brand recall for the drug is very high for the domestic business, and in US, it's just a commodity business. The lowest price wins. There's no brand recall, and competition remains high for both the markets. Yeah. So, what does it take to build a successful Indian pharma business or a successful branded pharma business? So, there are the key winning factors, right? You have to have leadership in a few key therapy areas, or you have to they'll generate a lot of cash. So, the M&A track record or the capital allocation that you do has to be good, right? You cannot do an expensive M&A or do an M&A in an unrelated area because you will generate a lot of cash being a branded business. MR productivity, I'll talk about what an MR is, what an MR productivity is in subsequent slide. And finally, big brands. Big brands when we spoke about those 170 brands generating one third of the revenue on the Indian market. So scaling up and successfully building big brands is key winning factors for the market. Yeah. So every company in the Indian market has tried to focus on a few core therapy areas, and they have tried to become leaders or gain maximum market share in their respective therapy areas because that's the one of the ways that you can win. When you go, broad based, it will be very difficult. But if you focus on key therapy areas, specific therapy areas, and you try to win those therapy areas, that's where when you can become successful. So here are an example of a few companies that are focused and gained leadership in a few therapy areas. So Alchem has done it for anti-infectives. Cipla has done it for respiratory. GSK has done it for vaccines. Ajanta, which is a very when you compare it to the whole context of things, Ajanta is a smaller company, right? But despite of that, they have built a niche for themselves in the ophthalmic category. So in every category, if you are able to be the leader, right, or have a higher market share, you will be successful. So let's look at the table on the right, right? That has all the therapy areas in the Indian market, and then there are companies that have higher market share in those specific therapy areas. So we discussed a few names, right? We can focus on that. We spoke about Ajanta having a very high share in ophthalmics, right? So they have about 9% market share in ophthalmics. So they are doing well there. We spoke about Cipla being the leader in respiratory. They have more than 20% market share, 24% market share. So they have built their leadership there. When we spoke about GSK in vaccines, right? So GSK has close to 30% market share, 29% market share in vaccines. So in every core therapy area, every company is trying to build leadership. And obviously, Sun is the leader in terms of market share in the Indian market, and that is why being a leader and they have a very high market share. They are leaders across multiple therapy areas. So we focus on Sun. They are one of the leaders in anti-diabetics, cardiac. They're doing very well. Gastro also, they are one of the leaders. Neuro, they are hands down. They are 23% market share, right? So they are the leaders in many therapy areas. Yeah. So when I spoke about MR and MR productivity, so MRs are basically medical representatives. So MRs are employees of the pharma companies. They go to the doctor, they explain the doctor, the efficacy of their drug, the advantage of their drug, and they ask the doctor to prescribe their brand of the drug to the patients. Right? They will give various reasons for it: efficacy, drug delivery, how the drug is better than the other drug. So that is the work of the MR, right? And here's a chart showing how many MRs each company has and what is the productivity. So productivity is how much each MR is able to sell to the doctor. So if a particular MR will be able to generate higher sales from that brand from various doctors, he will have a higher MR productivity, right? So similarly, and cumulatively, that company will have a higher MR productivity. And this MR productivity, how it will lead to better margins, right? Because the cost will be more or less fixed, right? But if that MR can generate higher sales by going to doctors, and those doctors are prescribing his brand, his company's brand, and if he can generate higher sales, the costs are fixed, whereas the top line keeps on churning, right? So there's operating leverage in play, and that will lead to better margins for these companies. So if we see for Sun, right, why they are the leaders, why they're doing so well, they have close to 12,000 plus MRs now. And despite of having such a high base of MR, their MR productivity is close to 10 million or 10 million plus. So that leads to better margins for the business. And we spoke about M&As, right? Very important part in the Indian market because you will generate a lot of cash. So here are a few of the big M&As that have opened that have happened over the years. So Abbott acquired Pyramid Healthcare for 175 billion rupees. One of the biggest ones was Sun Pharma acquiring Ranbaxy in 2015, right, for 239 billion dollars. Sorry, 239 billion rupees. So these are some of the I'm sorry. Yes, these are some of the big M&As that have happened over the years, right, in the Indian market. And recently, last year, we saw Torrent acquiring a portfolio of Curatio, right? Curatio was about 2,000 crore rupees. So usually these M&As happen either to enter a new therapy area or a new sub-segment of the therapy area, or if they see a lot of synergies in the acquisition. We should focus on the price paid for the acquisition. What is the expected payback period for the acquisition? Uh, Coming to the risks in the Indian market. So we spoke about so we saw those 2 years where the pricing growth was negative, right? So the National Pharma Pricing Authority is a body which keeps control on the pricing because otherwise the higher price increases will be a burden on the patients. So every 5-7 years, the government releases a list of medicines. These list of medicines are included in the national list of. So it's a list of medicines where the pharma companies cannot increase the price beyond the inflation rate. So it can be a very minimal price hike. These can be very important drugs for consumption, and that's why these are included in the list so that the pharma companies cannot go ahead and hike the prices significantly. That will be a burden on the patient. So that is one of the risks that the companies in the Indian market face. The second risk is genericization. So, as we spoke about the prescription, and in the US, when they said that the doctor will give pantoprazole, the drug. So, the government is also trying to increase genericization in the Indian market, moving away from the branded business. So, in that sense, they are opening Jan Aushadhi stores under the Pradhan Mantri Jan Aushadhi Prayojana. These Jan Aushadhi stores they basically give you generic medicines. They will not give you brand. They will give you generic medicines, and these medicines will usually be at a 60 to 90% discount to the branded medicines. So that will help the lower class of the society. They can buy the drugs for a cheaper rate. So the government is implementing this. The one more channel where generics is gaining traction is the trade generics channel, where the pharma companies itself will sell to the channel, sell into the channel only the generic drugs. They will not sell B2C, they will sell B2B, and they'll be generic drugs. So this channel has also started gaining traction over the last few years. Some of the pharma companies have started a trade generics division. Cipla and Alchem currently are the leaders for this segment. However, generalization, this remains a concern over the long term. Currently, quality is a major concern because for Janaushadhi also, the requirement of quality is GMP, right? Good manufacturing practices, which is a slightly lower quality requirement. And when you're having a medicine, you will usually not take a chance with your body. So quality remains a key concern as of now, and generalization for the Indian market is usually is perceived to be a very long-term risk, and in the near to medium term, it's poised to be driven by the branded business. Let's look at one or two case studies, right, in the Indian market, how successful execution in the Indian market fares well for returns. So there was a company in 2019, they had about 330 crores of sales. They had margins of about 10%, and the ROE was about 6.5, 7%, right? Uh, Cut to FY23, they did 500 crores of sales. The margins improved significantly to 21%, and ROEs were 22%, right? So that's a sales CAGR of 12%, which is broadly in line with the industry, slightly above. But the PAT improved by close to 58%, so 58% CAGR because of the improvement in EBITDA margin, significant improvement. And the PE went from 15 to 30x, right? There was a major re-rating. So in the last 4 years, the stock went up 675%. So a successful execution in the Indian business can generate very good returns for the shareholders. The stock is RPG Life Sciences, the case, right? So they made a strategy to recycle. They made a strategy to the balancing of their legacy brands, right? They introduced new products, new delivery system, and they removed the inefficiencies from the system, which led to improvement in the margin. So all these led to a very successful turnaround for the Indian business, and yeah, the stock went up 675% in the span of 4 years. Again, so yeah, this is the second case. Having discussed all the the benefits and how superior the Indian business is, uh, the question remains: is having only an India business sufficient for superior returns? Can we generate outsized returns just by investing in the superior Indian business? So here's a case. In 2017, there were two stocks, stock one, stock two. Uh, few parameters I've mentioned. The margins for stock one were 23%. Dividend payout ratio was 50 to 60% plus special dividends. ROCEs were about 29%. Similarly, stock two was 16%, 25%, and 17%. And both the businesses had more than 70% of the business coming from the India business or the branded business. So I know I'm not given all the parameters, but just on the face of it, if we look at this, we feel that business one, stock one, is much superior than the second stock, right? Let's see what happened. So this is the 5 year performance of the two stocks and the index, right? Uh, the stock two is Alchem, that has given outperformed the index, and the stock one, right? Stock one is Sanofi, right? So despite the stock one having slightly superior metrics, few of the metrics, it has significantly underperformed stock two, as well as it has underperformed the index. So why the underperformance, right? Uh, no reinvestment opportunities, right? So despite generating so much of cash, the MNCs, this is morely for the MNCs, they are not able to reinvest, right? And this leads to no growth. If we see the table below, there's a 2% growth on the top line, and 4% growth on the EBITDA. So there's no growth, right? And growth comes from launches from the global pipeline. So the majority of the MNCs, the growth comes from launches from the parent, right? They have to follow the strategy. When the parent wants to launch the drug in India, they will launch it in India. And other than that, it becomes very difficult for the MNCs to have growth. So if we see this case, it's very evident that because of probably lower introductions, stagnating growth, and hence the higher payouts because there was no reinvestment. So we segregated the index, right, into pharma, hospitals, diagnostics. We segregated that, right. Now we have again segregated this into pharma, right. We saw that 70% of the index, BSC healthcare index. But if we see IPM heavy businesses or branded businesses, right, be it India emerging markets, the which have more than at least more than 50% of the business coming from India or branded emerging markets, the market cap for those companies is only close to 4 lakh crores, right? Sorry. Yeah, that's only close to 4 lakh crores, right? So it's very important if you want to take exposure to the branded side or the India side of the business. It's very important that you cannot look at index as a on a broad base, right? Yeah, and here's the last 10-year performance of the index, then of a few companies that are more branded or India dominant, and then a few companies that are more that have a chunk of revenues coming from the US or the commodities index. So clearly, so JB Chem, Ajanta Pharma, Abbott India, Torrent Pharma, all these companies, RPG Life, all these companies are branded businesses. They are more India dominated businesses, whereas all the big companies like Sun Pharma, Dr. Reddy's, Lupin, Zydus, all these companies are where a significant portion comes from the US business, right? So, and the index has given 287% returns over the last 10 years. So, the India faced, so we are not trying to say which one's better at this point in time, but we are trying to say that over the last 10 years, the branded businesses have significantly outperformed more of US based businesses or commodity generic businesses. Here's a chart, 20-year data of how the healthcare index has performed over the last 20 years. So over the last 20 years, it has given 13% CAGR, 15 years, it's 17, 10 years, it's 12%, and over the 5 years, it's 17%. So at points in time, BSC healthcare index has performed in line or outperformed the broad Nifty 50 index, right? Now, this chart basically represents. So this chart is BSC healthcare index divided by the Nifty 50 chart. What it shows is that how the BSC healthcare index is has performed versus the Nifty 50. So if we see in 2015, right, close to 2015, 16, the ratio hit an all-time high, right, at 2.2, higher than 2.2. This showed that the healthcare index has performed much better than the Nifty 50 has performed. And this was because there was a patent cliff in US. The US business was doing significantly very well, and all these big companies made a lot of money, right? And post that, there was a higher price erosion due to various factors, and that's what led to the decline. But if we see as of 2023, it made a bottom, and again it has started moving up. A similar chart for Nifty Pharma, right, which is the bigger companies in the index. Again, this chart is again more prominent, where 2015 the it made a top where the big companies, because the big companies are US focused and the US business did significantly well. In 2015 it made a top, and again it went down and it has started moving up. So yeah, that's how relative to Nifty 50, Nifty Pharma has been performing. And let's look at the historical valuations, right? For Nifty Pharma, this is uh, the high was obviously in 2015. It went up to 77x. This P ratios, and it was 77x. The low was 22 and a half, and currently we are trading at 32%. Similarly, if we look at price to book, the high was about 9 times, the low was about 3 times, and currently we are at 4.5 times. And if we see the Nifty Pharma EPS, right? If we see the 2015 highs, right? it went up significantly. Then it went down till 2020. It picked up, and again post 2021 it went down. Right, this was because there was significant price erosion, a lot of competition, a lot of inventory in the US markets, and price erosion was higher. So the EPS had again gone down for these companies. And now, if we see after 2022, where the US situation has also improved and India business remains a steady business, so the EPS has again started to pick up and hit an all-time high. So what's the outlook for Indian business? So the Indian business is poised to grow at 9 to 11% over the coming years. Companies who are strong in their respective therapies should continue to outperform. We saw the examples of Cipla, Alchem. We saw the example of RPG, right? That they have executed significantly well. They've outgrown the market by a very big number. So they will continue to outperform if the execution remains strong. So we should look out for a good execution track record, management, very good management. They have a strategy in place for each of the sub-segments or therapies that they are working in. And Re-innovation opportunities remains a key highlight. Yeah. So coming to the fund, TrueBlue is coming to our fund. TrueBlue is a large cap fund. We invest in high quality large cap and blue chips. It's a completely blue chip portfolio. Uh, what's the I thought way and what's our investment philosophy? And this investment philosophy is consistent across all our funds. So we focus on long term investing, right? We do not look at very short term movements. We focus on long term, non consensus investing, right? We do a bottom up approach. There's a high focus on risk management. And what are we trying to capture in the TrueBlue portfolio, right? We are trying to capture the India's growth story, and we are also trying to capture global story, right? The global champions that are going to come out of exports. So what is the USP of TrueBlue, right? It's a 100% large cap portfolio. There are no small caps, no mid caps. It's a 100% blue chip portfolio. There's higher active share. So we overweight certain stocks that we feel are poised to do well in the long run. So there's a higher active share. There's a very low churn. It's usually a buy and hold strategy. No fixed fees, right? It's performance based. So as I said, large cap stocks, fully 22 stocks we hold in the portfolio. So when I said spoke about active investing, right? If you look at the top 10 stocks, right? For Nifty, it's about 17%, but for TrueBlue, it's about 25%. Similarly, if we see 15 stocks, top 15 stocks, for TrueBlue, it's 16 and a half, and for Nifty, it's 10 and a half. So this shows that we have a higher active share in some of the stocks that we believe will fare well. And below, on the right, there's a table of the top 10 stocks of Nifty and TrueBlue. So here we have tried to show the drawdowns of Nifty, right? When Nifty has weak periods, where how the other funds have performed, how the Nifty has performed, and how the TrueBlue has performed, in periods of stress. So we can see that Nifty on June 22 was down by 17%. The other funds respectively, whereas TrueBlue was down by 12%. So in that sense, the drawdown was much lower than the other funds as well as the Nifty 50. There's a one more example of the same on March 23. TrueBlue was just down by 5%, versus Nifty was down by 10%. So our endeavor is to generate risk-adjusted returns. Usually, the expectation is 200 to 300 basis points above the benchmark returns, and the time frame we look at is usually a 3-year period. The product suitability is first-time investors, retirement corporates, family offices, institutional investors, suitable for all of these. Yeah. Yeah. So the fund details here, Sham Shekhar and Mr. G.R. Balaji are the fund managers. We have a AUM of about 44 crores as of now, and yeah. Yeah, so the investment team I spoke about, Mr. Shyam Shekhar, Mr. G.R. Balaji, who is the co-fund manager, and with them we have a very wide investment team. We have a fund management team, we have a research team, we have a strategy team, investment team, and a product management team as well. This is the performance of TrueBlue over the time frames. So if we look at 1 year and 2 years, we have outperformed the index. Yeah, and these are the key terms. The minimum investment of 50 lakhs. Yeah, yeah. So yeah, we are done with the presentation. There are any questions? It'd be great to answer. Yeah. So the first question is, what is the Yeah, so the CAGR for 24-25, the industry is poised to grow between 9 to 11%, as I said in the overview slide, right? So it can slightly grow higher in 24-25 or be lower in 24-25. But over a 4 5 year period, or even over a 10-year period, the growth is expected to be between 9 to 11%. And the companies that are focusing on specific therapeutic areas are doing well or have leadership are poised to grow higher than the market. Yeah, so we do have pharma stocks in the portfolio as well, of 22 stocks. But that the universe for us will be Nifty 50. So from Nifty 50, the pharma stocks from Nifty 50, whichever pharma stocks we have and whichever we feel will be doing well in the long term, we do have a position in that. Yes. So yeah, so when you talk about technology disruption in the generic business like genetic engineering, okay, so this technology, a few of the global pharma giants have been still working on something like this, right? Yeah, am I audible, Sanjay? Hello? Yeah, okay. Yeah, sorry. So, I was saying that some of the few global giants have been working on these disruptive technologies like genetic engineering, or when you call it I'm not sure, but cell and gene therapy, if you are referring to. Uh, these are at a very nascent stage as of now, and at least in India, the technology disruption risk due to this remains very low. And I'm pretty confident, if this becomes the norm of the market, let's say 1 decade from now on, that these therapies are being used worldwide. I'm pretty sure that they will be introduced in India as well, and by our Indian players as well, right? Because we historically we have been very well on the generic side, and any of the new drugs that have been launched in the global market have eventually come into the Indian market. And now we are also going more on the drug development or drug discovery side. Some of the companies are working around that. A few names like Sun is working on a few, Walcott is working on a few. So these guys are also working on new technology. Yeah, so I don't see it as a disruption risk, at least in the near term. And even if this comes in, I think the Indian businesses will launch some of these technologies in India as well. I hope that answers your question, Mani. Yes. What do you mean by do they have a hedge? I'm sorry, I didn't get your question properly. Do you hedge as in, are you talking about a currency hedge? Okay, so okay, the question is, will API companies have a better growth rate? Uh, so it's not always that. It depends on the business model, right? Let's say a company that is usually working on a lot of generic APIs and not a lot of APIs which are new age, or or they are not partnering with some of the innovators, right? They could have a lower growth because that will be in the generic market. They will have price erosion. They will have a lot of competition. So those companies, the generic, very generic companies who are making generic APIs could have a lower growth, than the ones who are doing a lot of new age APIs, or on the CDMO side partnering with the innovators or otherwise. Right. So, Ayurveda, okay. So, this is a very subjective question. I believe that Ayurveda is not something new that has come into the system, right? It has been there over the years, and the adoption of it has been there with a few subset of people that believe in that, that side of the medicine. But if we see the data, and the data clearly suggests that for some of these chronic ailments, if you see globally, right, the GLP-1 drugs have performed exceedingly well in newer and newer indications. Now there are trials going on for other heart ailments as well. But if you see these giants like Eli Lilly, they have shown much greater efficacy in therapies like diabetes or weight loss. And if you see, the numbers, how they have grown over the last few years, that's staggering. So I think it's mainly on the efficacy of the drug. If you can show a better efficacy without side effects on the drug, then I believe a greater portion of the population would prefer that. But it's very subjective. Ayurveda is there since many years, and the adoption of the same is done by a few subset of people. Yeah, sure. Okay. Thank you, Sanjay. Thank you, Gopinath.